Originally, I thought there would have been more winners than losers from this program, but I'm starting to think there might be more losers than winners.
A lot of people see just the highlights. They see, oh, I get 95% financing. Oh, I get a 50-year loan. And they go, oh, crap, I can buy an apartment building with so little money. I better just run right into it with no research, no understanding, no backup plan. So there will be people that get burned.
We've almost oversupplied some markets on the rental side, and that there's going to be some upward pressure on vacancies, and clearly there's downward pressure on rents.
What does making housing affordable actually mean? Well, it's not a magical word that doesn't mean anything. It means that prices have to fall.
2 months, 3 months free rent being offered. You don't see things like this in a normal rental market.
People shouldn't be buying investment real estate because of a financing program. You still have to have a fundamental reason why buying that building on that street corner in that neighborhood actually makes sense. But there are always going to be neighborhoods where there's a need for housing, where there's a need for demand. And if it's based off the fundamentals, there's always still going to be money that can be made.
Hello and welcome back to another episode of the podcast. Today I'm joined by Jake Steinman, broker of record for Meta Realty, and Dan Foch, chief real estate officer at Valerie and co-host of the Canadian Real Estate Investor podcast. Guys, thanks for joining us.
Thanks for having me on.
Yeah, thanks for having me. Excited to chat here.
Great. So today we're going to be talking about the CMHC's MLI Select program, which is a loan insurance product for multifamily rental housing. And I know that sounds like a pretty dry subject, but it actually has pretty wide-ranging implications for the rental and housing markets in Canada. Jake, why don't you kick us off here by explaining what MLI Select is and why it matters?
Sure, absolutely. So very high level, CMHC's mandate has basically always been to get more housing in the hands of Canadians. And most people know them because they work on the sort of residential side, right? Helping people get a top up on their loans when they're trying to buy their first house, their first condo, that sort of thing. But what a lot of people don't realize is that mandate to get more housing in the hands of Canadians extends to rental product as well. So essentially what CMHC has been doing going back to the 1960s is creating financing incentive programs that make it easier to either buy and rehab or to build new buildings. And MLI Select is essentially just the current iteration of that program designed to incentivize either that buy and rehab or development of new apartment buildings across Canada.
Right. So it's not just for new construction, it's also for rehabilitation of existing buildings or, renovation. I believe there's energy efficiency incentives in there as well, right?
Correct. So a lot of people do use it on the sort of buy and rehab of existing buildings, whether that from energy efficiency, or they also have a big push on accessibility. So for people that need different access to buildings and that sort of thing. And that's where a lot of people focus on when they're taking older product and trying to kind of bring it up to modern standards.
Yeah, I think for the energy efficiency component, it was basically for a long period of time you could buy like an older building. It was super common in Atlantic Canada, where people would take a older building that had a hipped roof, so like a peaked roof, and they would, in Atlantic, you're typically on an oil furnace. So what you had to do to qualify was get a 40% improvement in the energy efficiency of the building. And so, during that period of time, it was, take the insulation out, blow in your R60 insulation in the hipped roof, change all your toilets to like low flow toilets, shower heads, a lot of the appliances, go to Energy Star, and then swap the oil furnace for heat pumps. That was like a pretty common trade in the market for a while. People were like going in at, whatever they'd buy with private or bridge debt, and then basically do the renovations. And they were getting like over 100% loan to value takeouts from CMHC. So they clamped down on that a little bit. And this has sort of been a theme with the program, is there's been like these gradual clamping down on some of the, I don't want to call them loopholes, but like some of the more efficient or like investor friendly components of the program. They're trying to make it a little bit more in favor of their like the goals that they express with the program, which is energy efficiency and affordability and accessibility.
Absolutely. They usually come out with a set of rules or terms sort of every quarter. And then, like any good investor, any good financier, people find the loopholes, they find the ways to really maximize the returns. And then CMHC abridges those terms, modifies them to try and really focus people back on the kind of core values they have. Their pound of flesh, as I call it.
Yeah, I did see that in the Globe and Mail 6 months ago. You were quoted in the article, Jake, but it was people who had been fulfilling the 5-unit requirement, like 5+ units, and they were doing it by bundling together the purchase of several single-family homes and using that to secure a commercial loan that might have, a higher LTV or a longer amortization. And they kind of unexpectedly started denying people for that. I guess I understand why they did it. It wasn't really their intent for people to be purchasing existing homes and repositioning them as rentals. But it does seem to just change it on a dime like that when they were approving those before and then suddenly start denying people creates a little uncertainty.
Sure. Well, the actual core reason behind that is a little bit misunderstood. I think there's two sides to what happened 6 months ago. One is there was some bad optics around a Canada-based bureaucracy kind of funding buying up of single family homes, right? Because it's like, that's the Canadian dream. You get your own house, that kind of thing. But that wasn't actually the primary driver of why they clamped down on that. The main reason was because people were using it to essentially build new homes on 95% financing and then sell them off individually. Which technically you're not supposed to do anyway, but the penalty was worth the crime. So they really just wanted to stop essentially allowing people kind of a loophole to get the best financing in the world to act as a home builder and selling off homes. Because you technically still can actually buy 5 detached homes and put them under the program as long as you actually merge the lots and the pins with the city registrar.
Okay. I mean, what would be the implications for a buyer in that situation? They'd be on the same lot as everyone else, or do they just subdivide it after?
You would own them all. The point was CMHC will still allow you to do it as long as you don't have a path to selling them off individually after the fact, right? So if you buy 5 good, merge them onto a single title, which obviously, we're going down a rabbit hole, but obviously the city also has to agree with and the neighborhood official plan has to allow, you can technically still do CMHC under that program.
Ontario, that process happens naturally too through like land registry, right? So if you own like, if you do it, a lot of people in the city of Toronto now are doing these through like small lot severances. So they'll take like a 50 footer, maybe 50 is a bit small, but like, yeah, I guess a 50 footer is severed into 225s. And now in certain areas of Toronto, you can do 6 units plus a garden suite. So you would do a semi-detached sixplex on either side. So 12-unit building basically with one party wall and then 2 units in the back. But then you would have to get site plan, obviously, because it's over 10 units. But that's kind of an example of one where it works because in Ontario, if both of those units are owned by the same person, then the pins actually merge
automatically. Yeah. In Alberta, they don't merge automatically, which is where we've been focusing more, but we've successfully actually taken buyers who bought under that original program and kind of got snagged by the changes. And we have closed their deals under bridge financing, merged the pins, and then reincorporated them under CMHC. So it still works. They just made it kind of a mess, right? As you say, they keep making it harder and harder to get certain kinds of things done.
Oh, that's pretty into the technical weeds, but if we get to back more to, I guess, kind of the core purpose of the program, which is to increase the supply of rental housing in Canada. I mean, have we seen that much new construction as a result of this program, or has it mainly been repositioning older buildings through renovations?
Definitely a lot of new construction. I think we're building like record rental construction right now in a lot of markets. So we would say it's obviously had a pretty profound impact in rental supply creation. I'm of the opinion that maybe we've almost oversupplied some markets on the rental side and that there's going to be some upward pressure on vacancies and clearly based on your guys' research, there's downward pressure on rents. But it seems to be definitely accomplishing their goal of delivering more affordable housing supply.
I see that as well. I mean, across Canada, the program is being used like never before. I believe the last 3 years in a row were the highest utilization of CMHC's commercial insurance for construction ever in Canadian history. So doors are being delivered. And definitely there's certain markets where there's a lot of supply coming online rapidly.
Yeah, that could be a healthy indicator, I think. Yes, we are seeing record rental building construction, but before that, it was basically the cost to build was so arduous because of all of these, financing costs and regulatory delays and all these hurdles that you have to pass that really all we were seeing being built in the past was stuff at the very top end of the market. Um, Whereas now you have more projects becoming viable. So instead of having this trickle of luxury supply, we're starting to open up more units. We might end up getting a little more vacancy and, kind of, I would call it normalizing the market because we saw near zero vacancy rates in, just a few years ago. And it's starting to loosen up a little bit, which I think is at least helpful for renters for sure.
Yeah. I mean, if you look at it prior to like since the 70s, basically, there's been almost barely any new rental supply being delivered. It's just, as you said, the economics didn't work. The cost of construction, the cost of zoning, the cost of land acquisition across most of Canada just did not paper. And even if it did paper, the highest and best use of a lot of those opportunities was to build and develop either condos, towns, or detached for sale, right? You're getting a way higher return on your investment. And that's definitely flipped on its head since probably about 2018, 2019. And really over the last couple of years, it's gone absolutely crazy with the amount of supply that will be coming online.
Yeah, I think, I mean, I guess my concern with, like, I think the program's done obviously a really good job, but my concern is like a lot of investors aren't really paying attention to, and this is where real estate's a really tough market, like because your supply chain is, um, it's longer, right? So if somebody's contemplating a project today and it takes them 2 years to complete that project, they're stabilizing or trying to refinance in a much different environment than, um, when they deliver in whatever 2027 or 2028. And this is what creates a lot of risk. Now, I'm not necessarily saying it's become a bad investment, but I think that a lot of investors haven't taken the time to educate themselves on those risks. And because I think you're playing with fire a little bit with this product, and because it's so high leverage, right? And if you get stuck holding the bag, it's a massive loan. It's not like, a condo, like a pre-con condo where it's like, yeah, you could probably service it with your income. It's like, if you're out on this thing, it's $3 to $5 million at and I think CMHC's done a pretty good job at de-risking that. Even if we just talk about the layers that they've introduced recently, the rental achievement holdback, obviously, right? So they'll scale back your loan, they'll right size your loan if your NOI doesn't hit your pro forma rents, which I think, we haven't seen a lot of that yet, but I think that they are doing it in anticipation of a lot of the pro forma rents being a headwind, or seeing some headwinds. Similarly, so basically, like if your vacancy jumps or your rents come down, let's say your pro forma said you were going to hit 100K NOI and you only hit 80, they'll reduce your loan amount by the proportionate amount. So that's one. And I think the other piece that they did was they started requiring a larger cash and equity guarantee on a lot of the borrowers, which I think has limited the number of people or type of people who can play in this space, which is probably, hopefully, gotten rid of some of the speculative element that seemed to be evolving on this stuff a little bit, right?
Yeah, they made a couple of changes that definitely reduced a bit of the fraud for market. Those are two of them. The other thing is on the construction side risk for new product. They also have started doing a lot of holdbacks on the construction draws as well. They want to see the builders actually have a little more capital on hand to build. They're not giving every single dollar right away. And then the other piece, which I actually like, even though it adds costs to the projects, is pretty much every project now has to have construction bonding, right? And without going way in the weeds on that, it's like an insurance policy for the actual construction of the project. So you don't have to worry about a builder running into cost overruns, not being able to pay the suppliers and that sort of thing. It covers off a lot of that risk. So they've definitely clamped down over the last 2 years to try and really tighten that up. But Daniel, I agree with you that just like anything, a lot of people see just the highlights. They see, oh, I get 95% financing. Oh, I get a 50-year loan. And they go, oh, holy crap, I can buy an apartment building with so little money. I better just run right into it with no research, no understanding, no backup plan. So absolutely. But there will be people that get burnt for sure. But that's like anything, right? I mean, adult investors, caveat emptor. People did the same thing with pre-construction. They've done the same thing with almost every asset class in history. It's the nature of the game. There's always going to be winners and losers who actually do their research and actually do their due diligence versus don't.
Do you think there would be more, like, I'm curious. Originally, I thought there would have been more winners than losers from this program, but I'm starting to think there might be more losers than winners. And I'm curious to get your take on it. Like, I just, based on a lot of the people that I am hearing asking me about this program, it's like people who really shouldn't be playing in this space. And I'm just curious, like, I feel like it could be a 50-50 split now.
I would guess it's going to be very geographically dependent. So that's like, it's not a macro question, it's a micro question. Like, there's going to be areas of this country where people get hammered for sure. And then there'll be other areas where the majority of people do okay. But I would say definitely more than half the people should do okay. I mean, as long as people aren't running into this with a shoestring budget where they don't have a single extra dollar to cover any unexpected expenses or cash flow shortfalls in the short run, they should be okay. And with CMHC requiring that equity and that liquidity to be on hand, people should have some sort of buffer, right? I mean, we always tell people it's not a get rich quick scheme. Does this program have a lot of power and a lot of ability to make you money? Absolutely. But it's a long game, and over 10 years, you'll make money. And any given year, you can lose money. Do they listen to our advice? I don't know. but there'll definitely be losers. I don't think it would be more than 50%. That's a monster. Like, that would be a disaster. CMHC would have to do something at that point.
Well, I mean, they exist to do something anyway. Like, by its very nature, they are doing something by being there as an insurer. Like, no lender. The program exists because no lender in their right mind ever would lend on a 4.4% yield to cost on a 50-year AM with the lowest debt service coverage ratio in the market. Like, that
No, but what I
go
mean
tell a
is, like,
U.S. investor to buy that deal and they'd laugh at you, right?
of course, when there was cost overruns and delays on construction around COVID timelines because of things completely outside of people's control, they did interest amnesty and they did amortization extensions on those loans, right? So I'm not saying CMHC would do this tomorrow, but if you had a situation where more than half of the projects were going into default, that becomes a countrywide problem. It's not a local problem anymore. So I don't think we'll ever get to that scale, but I mean, the banks don't want to be taking back in power of sailing 50% of these deals, right? That would be a very bad situation for the country.
You can almost argue that the same thing happened with just the regular residential mortgage loan insurance, right? People started using that
Yeah.
as an investment product, and some people did it responsibly. Some people got themselves into trouble because they were operating at very, very high leverage, and they just didn't have the cash flow to cover it.
It's like anything. Leverage is a very powerful tool. If you use it right, it can make a lot of money, and if you take the wrong risk, you can get yourself into a lot of trouble.
So if we're talking about the recent announcements by the government around Build Canada Homes, that's essentially a program that is mainly going to be focused, from what I've read, on providing subsidized financing for new rental construction. Do you think these programs are going to be cannibalizing each other at all, or are they just redundant, or like what are the practical differences here, and what do you guys think will be the impacts on the rental and housing market?
So I would love to see what the actual terms, conditions, and offering is, because what do we already have? I mean, there's a bunch of different subsidized financing programs for rental construction as it is. So really need to understand what the difference is going to be.
Yeah, yeah. I think from my perspective, like we knew this was going to happen at some point. Like they're just throwing the kitchen sink at the problem. And I think that there's going to be probably like you just end up with whiplash and like volatility as a result of this, right? Like I do think that we're like if you take a national look at housing right now, especially with population growth falling and rental supply rising, like rental supply is at a record high. We're building more apartments than we ever have. 80+% of those are come from CMHC programs. And I think that in a year, maybe even like already, like people who can see it early, but in a year, like we won't even be talking about, lack of housing supply, right? I think we'll be talking about, you'll be hearing about problems from investors having a hard time filling the supply, given like if there's a lot of these markets, like Kelowna and Barrie as an example. Like Kelowna has like 30% of the rental supply under construction. Barrie has like 20%. It's like if there's no new household formation in that market, no population growth in that market, then that's a direct injection to their vacancy rate. And so I think that we probably have more. We have like unfortunately, you have to realize the negative consequences to the downside as well as the upside. And we already saw the upside negative consequences: runaway rents, runaway prices, et cetera. And because of real estate being in its long run nature, um, if you're forced to overshoot, right? Like, oh, hey, we have this problem. Everybody start building right now. Let's throw the kitchen sink of policy at it. CMHC, lever up everyone and their mother. Let's, all go out in there and build a bunch of apartment buildings, and the government's going to start building, and, we're going to waive DCs on everything and blah, blah, blah. All of these things are deflationary on house prices and rents. And so, and then they all start when this urgency gets applied, which is present day. Then you go basically, okay, now all of these things, they take 3 years. So 3 years go by, and now all of a sudden you're actually seeing the manifestations of these policies. And now you're in an environment where rents are down, where they're down 10% year over year, probably got another 10% downside risk. Vacancy is probably going to double. This is where things start to get bad. And I think, to me, you look back at this in like a cyclical fashion. Like, go back to the 1990s. 1990s, like, it was the exact same story, right? Everyone was flipping paper on, like, pre-con detached houses in like suburban GTA, and the market got completely blown out. But like in 89, everybody knew someone who made a ton of money buying and selling real estate. And then by 1993, everyone knew someone who lost a ton of money buying and selling real estate. And then you get to this point where the entire, like, that has a huge sentiment effect. And we're going through that right now, where it's like this asset class that people are afraid to touch. And that's when you actually reach, to me, like the full point of healing, where you only really have the investors who actually care about investing in real estate, who want to do a good job at it, who want to be housing providers, et cetera. You shake loose a lot of the speculators and the people who are doing it for the wrong reasons and think that they can just go flip paper and whatever. Um, we're like, I don't know, third, fourth inning in that process. But I think that that's like, that's what this cycle looks like. And, fast forward 10 years, there will be a lot of good providers in the space, and there will be, most of the bad ones will have gone under, and rightly so. It's economic Darwinism. We're just like going through that. And I think that there's a lot of negative data points that are going to come out of illustrating to you kind of like, or quantifying what that process looks like.
Yeah, you have a lot of great points in there. And I think the most important thing to take away from that is, what does making housing affordable actually mean? Right? Because at the end of the day, you have all these people saying we need to make housing affordable, whether that's on the purchasing side or on the rental side. Well, it's not a magical word that doesn't mean anything. It means that prices have to fall one way or another, right? If too much productivity, if too much capital is tied up in housing, it hurts the rest of the economy. And that might be bad for me as a real estate investor or the other landlords out there. But there has to be some target point of, what do we want the rent in this city to be at? Or what do we want the cost of a detached home or a condo to be at? And you can't make things affordable if you don't actually have prices fall by creating more supply. So whether, that's the point. Like, as you said, just like in 89, 90, 91, there are going to be people left holding the bag who bought things at the wrong price in the wrong location at the right time. But as you said, that is kind of what's going to allow a better economic outlook overall for the country. And the people who are buying the right stuff in the right place at the right price and are in it for the long game will still make money, because there's always going to be people that need rental, whether rents are at a higher level or a lower level. Going back to the 80s and the 90s, people who bought apartment buildings at the time because they believed in that product, that space, and that long-term opportunity, most of those guys still own a lot of those buildings, and they've made millions of dollars off of them. But the guys who are in it for just the quick flip or the quick upside definitely will get burned. But that is 100% where that healing of the economy can come from. Because if you have way too much capital tied up in real estate, which is what's happening right now, how can anyone do anything else productive? In terms of if we need this other bureaucracy, or if everyone's being pulled in another direction, I would argue that the biggest barrier to housing right now is not the financing. It's not federal government programs. It's at the municipal and provincial level, right? The biggest barrier to getting housing built easy and affordable is just dealing with the cities. And Toronto arguably has gotten a lot better, but they still have miles to go. And unless this federal funding is tied to forcing municipalities to actually get stuff done, it's still the biggest barrier. Full stop. Nothing. Arbitrary. I'll speak very negatively about what the city council in Toronto is doing. The fact that they just arbitrarily pick winners and losers. Oh, now we can do a 6-plex, or we can do an 8-plex, we can do a 10-plex. The question is why, right? Like, why are they arbitrarily picking those winners and losers? Why aren't they just saying, you know what? Development charges do add too much cost to building a rental building. They do make it impossible to paper the numbers. The fact that it takes so long to go through a zoning application does add an incredible amount of cost. If you're going to say development charges make a 6-plex not work, then it also definitely doesn't make a 40 or a 200 unit building work. The financing is easy. If the numbers work on paper, you can get the loan, right? So to me, the single biggest thing that needs to get fixed is at the municipal level. And the proof is in the pudding. If you look at Alberta, why have Calgary and Edmonton both had an explosion of the missing middle? Daniel's favorite thing, the 8-plex, right? The 6-plex, the 8-plex. Because 2 years ago, the federal government told the cities, if you want funding, you have to make it as of right zoning around the city. And boom, overnight, developers started buying land and building these things. And they made the process fast. They made the process easy. There's no development charges. There's no land transfer tax. So to me, it starts with the municipalities, and they're finally waking up, but they still have miles to go, especially in Ontario.
Yeah, I think it's a very common criticism I've heard of municipal city councils, things like that, is that they don't really understand the capital cost of money. If you're sitting at council or, in an admin meeting and you say, okay, guys need to go back to the drawing board on this, it'll take another like 6 months or a year. From their perspective, there's no cash outlay exactly. So I think there's no cost to that. But of course, there's carrying costs of your project, there's the rework costs, and then there's escalation costs for construction, right? It's going to get more expensive to build every year. So there's definitely, these financial levers that can be pulled at the federal level, but there's also a lot of regulatory levers that can be pulled at the municipal level. And I think, Dan, as you mentioned, Kelowna is going to be an interesting example of that, of how sometimes we tend to over or under correct. I think we spent a long time undercorrecting and just accepting what was happening in the real estate market because a lot of people were making a ton of money. And as you said, we saw those upside negative consequences like a lack of affordability. Whereas in Kelowna, they have, I think, been making a good faith effort to make it easier to build rental buildings and providing a lot of incentives to do that. And this is at the same time that the federal government is doing all these things. So now they've had this big surge of rental units coming onto the market. But what doesn't get talked about a lot either is that Kelowna is also one of the top destinations in BC for international students. And so they're going to be seeing downside risk on that side as well, because, international students, there's a big pullback in that now with the study permit caps and things like that. So
Yeah, it makes you wonder whether or not that's a policy lever that I mean, obviously like public sentiment is definitely defeated on all of those immigration programs. Temporary foreign workers under fire right now. Obviously the international student stuff. But it makes you wonder if that like once they have let that run its course and there's a little bit more public faith in those programs, or they're kind of like, oh, you guys asked for it, like, here's the consequences, and now all of a sudden we're sitting with this like absolutely decimated Canadian economy, and Canadians would let a politician do anything to their country at that point to to try and create some growth. There's like, to me, everything's on the table, right? I don't know if we get there, but I think you see a resurrection of those programs eventually. I think it wouldn't surprise me if they just let the foreign buyer ban expire down the line as well, in 2027 when it's supposed to expire. Like, but as it stands right now, they're doing everything to the downside. Like they're trying very hard to appease the Canadian consumer, and eliminate a lot of the consequences that they've created, which is probably the right thing. It might just be, I won't say too little, too late. It might be too much, too late, honestly, because they're trying to make up for 3 years of not doing anything, and now they're doing it all at once. And it's like, again, it's that whole whiplash thing, right? Had they adjusted interest rates up slowly way earlier, then it probably wouldn't have been as big of an issue. Had they adjusted immigration, population growth in all of its forms down a lot more slowly over time, or just not let it get so high, we probably wouldn't be dealing with these whiplashes. But when you have policymakers who overshoot to the upside, they have to overshoot to the downside to correct the problems that they've created. And then I'm just fearful that this is going to have like a lot of serious turbulence for the housing market in the short term, like in the next probably 3 years.
I think you're right. There's going to be a lot caused by that, but that's how our policymakers, our government has always been. I mean, show me one time they proactively were on top of anything. They don't understand the word proactive. It's not in their vocabulary. You can have 50,000 people screaming from the mountaintop, this is going to cause a problem. They say, you're crazy. It's not going to do anything. And then 2 years later, they go, maybe we took in too many temporary foreign workers, or maybe we did keep interest rates too low. So they're always going to do this yo-yo of overreaction. And then the biggest problem is other industries can adapt faster, but real estate has one of the most inelastic supply curves on the planet. Like once you're on the path, you're committed. Once you've bought the land and once you've sent in your zoning application in that set of rules with that municipality, you're there's nothing you can do, right? And we're seeing the pain that the condo developers are going through in Toronto now with the thousands of in-process applications that existed. So if the policymakers yo-yo and suddenly there's no supply or no demand for temporary foreign workers or for international students, then absolutely there's going to be a ton of pain in the real estate side valuations and rents in those kinds of markets. But what can you do at this point? I mean, it would be political suicide for the Liberals government to come out and say, well, there's too many building permits in Kelowna right now, so we have to allow a bunch of bunch of temporary students in. Like, there's nothing they can do. The public sentiment doesn't align with the realities of what's going to happen.
Yeah, although what's interesting to me is that I would say that of the temporary resident programs, international students is probably the least controversial. But from the data we're seeing and the projections I've done, that seems to be the program that's getting hit the hardest by new government regulations. It's seen the steepest decline. And in terms of how that's going to affect the real estate market, it's also one of the programs where the demand is going to be most concentrated in particular locations, not just, cities that have post-secondary institutions, but just the radius around the post-secondary institution, right, is where most of the student demand is going to be concentrated. So I think at, the micro level in these smaller markets, you could see some pretty serious effects.
I
I
think
agree.
Yeah, you look at the Kitchener-Waterloos of the world, right, where you've got basically, like, you had Conestoga increase their, international student enrollment, plus you have, Laurier and Waterloo, which obviously big international student population. Um, they increased their rental supply because they saw this trend that, we have Conestoga has 6,000% or, like, 4,000% more international students. There's our demand. Let's build some houses, and then by the time they're done their project, that doesn't exist anymore because it just got regulated away. And so while I think that these policy outcomes are, or the policies and their intended outcomes are probably things that Canada needs right now, it doesn't, I can't ignore the fact that there are serious consequences for the investors who did those projects that now can't stabilize, or at least can't stabilize. Like, if we're going back to kind of the topic of CMHC, MLI Select, a lot of these landlords need to stabilize at the rents that they pro forma'd, and so this is why you're seeing in the market right now. And I think you mentioned this on our last recording, was basically 2 months, 3 months, free rent being offered to people. You don't see things like this in a normal rental market, and the reason, well, why don't they just decrease their rents? Wouldn't that make things more affordable? Well, they can't, right? They are decreasing their rents in the form of annual rent because they're giving you, a quarter of the year for free, because if they don't hit their target rents, then they're not gonna get their takeout financing, and now their whole project is in jeopardy. And so there's huge distortions that come as a result of these policies. Again, they're all good for housing affordability and for renters, but they're not necessarily good for contemplated projects, for land values, for developers. And it's not to say that, like, nobody's weeping for developers. They've all made out like bandits over the last decade, and it like, I wouldn't say that, you always hear the terms of, like, bailouts, et cetera. I think a lot of these programs are functionally bailouts for developers anyway. Um, you know, if they can't survive, it sucks, and it's kind of that economic Darwinism that I referred to, but it's also they're laying off their admin staff or their architect or whatever, and there's ripple effects that happen as a result of that. Fewer shovels in the ground means fewer construction jobs, and we're seeing unemployment rising massively. And this is how the housing piece and our economy being overexposed to housing in general can become a very big problem in the fullness of time.
Absolutely. And I think that's why it's very important to understand, getting back to CMHC, that people shouldn't be buying investment real estate because of a financing program. The financing program is the icing on the cake, or the cherry, or whatever you want to say, that makes the returns work way better. You still have to have a fundamental reason why buying that building on that street corner in that neighborhood actually makes sense at a fundamental level. And I think that's very important, why people need to do their due diligence and properly understand what the demographics of that neighborhood are, and why, if it's growing, why there's demand for housing in those neighborhoods. Because if you look at specific areas like where we target, you'll find that, these things like that, like the international students, and are not a huge component of a lot of that demographic. So it's absolutely important. And I think that's why we can't look at real estate on a completely macro scale across the country. Canada is a very big country, but there's going to be a lot of places where, places that were mentioned here, where that demand is going to fall off a cliff if we really kill the international student program like what we're seeing. But there are always going to be neighborhoods where there's a need for housing and where there's a need for demand. And if it's based off the fundamentals of why people want to live in those areas, there's always still going to be money that can be made. I mean, even in the worst of the 2008 recession, when U.S. housing starts dropped 66%, there was still areas where developers could sell and make money building new homes, right? So it's not like it becomes a raised earth situation or apocalypse. It's just that on a macro scale, numbers can look ugly, while on a very localized scale, there's always going to be opportunities. But that's where I think Daniel's right, where a lot of people can get burned if they're just looking at the headlines of why CMHC MLI is good versus actually digging into why that location, that building, and that price is good.
Yeah. So, talking about due diligence, I think we can wrap this whole episode together with a final question here. Uh, Obviously, this is a very chaotic time in the market. There's a lot of uncertainty. But if people were looking to take advantage of this program to start a new project, buy a building, what are some of the key pitfalls they should watch out for, and what are some of the things that they should be looking for in terms of what makes a good opportunity? Dan, let's start with you, and then Jake, you can have the last word.
Yeah, I think the biggest one is sort of in line with what Jake just mentioned. Like a lot of these things that we put into like your model is only as good as your assumptions. And if you don't stress test those assumptions away, then you're at risk of something going wrong with them. And if there's one place on earth that it has made it exceptionally clear that that isn't something that we should be taking lightly, it's Canada, right? Like you can have Airbnb investors can have their entire model regulated away overnight, right? Same thing with this stuff. If you contemplated a project on the assumption that international students in your market were going to sustain that growth, or if your city was going to continue to experience whatever 4% or 11% population growth, like a lot of the investors in the Calgary market, you're going to run into trouble. Would you still do this deal if that assumption disappeared, or if that population growth dropped to zero? If the answer is no, then don't do it. This is a very easy way to de-risk things, and the same thing would be true. And this is my biggest um, bone to pick with people piling into MLI right now, which is many people are doing it on the like. It makes sense if rents are going up and vacancies are stable and valuations are going up, but in many markets in Canada right now, those things aren't true. And it's not to say you shouldn't do the investment, but it's a question of would you still do the investment if you actually put in 10% falling rents in your model, or vacancies at 6% in your model?
Mhm.
And in a lot of cases, that's not what I'm seeing in the market. And those are the investors who I think those are going to be the losers from this program, the ones who underwrote too ambitiously and didn't stress test their models. So the biggest thing I would say in your due diligence is gather your assumptions and stress test them properly. That's really the easiest way to make sure that you don't get crushed by this.
Yeah. No, I agree completely. The biggest thing is who cares about what it looks like if everything's going perfectly? It's what does it look like when shit's hitting the fan, right? If either you're in a way higher interest environment where your rents are off 10, 15, 20%, or vacancy rates are off 5, 6, 7%, or it's taking you longer to fill the units, where is it that you can no longer afford to carry it over the short run? Or what is it that your break even is in like a worst case scenario? If you as an investor are okay with that worst case scenario, and like a real worst case scenario, not saying, oh, what if rents go down 2, 3%? But what if rents come off 20 points? People say, well, how often do rents come off 20 points? They can do it any time. Look at what's happened across Ontario over the last while. If you can handle that, if you're okay with where the numbers settle out when that happens, or interest rates went up 1%, then it can work, right? But don't always buy something for the best case. The best case is when everything goes smoothly, awesome, we made money. You should be buying it for your worst case. And the other pitfall that I see a lot of guys fall into is, and this kind of goes back to, I think, a lot of the unsophisticated sort of mom and pop investors who are used to buying pre-con condos and that kind of thing, is they're happy to accept any numbers that they get sent by any agent, any person who claims to be an underwriter or know anything about the business. I mean, I was looking at a building someone sent over in Port Credit. It's like an $8 million projected building. They had $12,000 for property taxes. I'm going, how the hell are you going to have a $12,000 property tax bill on an $8 million building, right? And meanwhile, I had 5 people telling me this is the best deal they've ever seen. So even if you're not worried about what's your worst case, at least double check the basics and make sure the numbers you're getting actually come from some realm of sanity. Because CMHC will do its own little bit of checking. Your appraiser is going to do their own little bit of checking, but they do give you quite a bit of leeway because of the EGI holdbacks. They are more than happy to take your numbers and say, prove it, right? And that's where a lot of people can get into trouble. So make sure that the numbers you're forecasting are actually achievable. They're actually accurate. Like, a lot of stuff is not hard to find out. You can call an insurance broker and ask them how much is the insurance going to be on your 8-unit building. They can give you an answer in 2 minutes, right? But then run your model, and as Daniel said, for the worst case, and see if you're comfortable with that. And if you're comfortable with that, then buy it, because over 10 or 15 years, you'll probably do well. Over 5 years or 2 years, no one can guarantee anything.
All right. Good advice for uncertain times. Well, thanks guys for joining us, and we'll see you next time.
Thanks for having us.